There's an interesting theory about what Iran, Russia, and China are doing right now. The theory says they figured out that they don't need to fight the petrodollar, right? They just need to build an alternative system, and each one of these countries has a part of the missing puzzle, if you will. For example, Iran has the choke point. It controls the Strait of Hormuz, of which 20% of the world's oil flows through every day. And every day that the strait is closed, the global economy gets a little bit more desperate. And Iran is using that leverage to make an offer to the world. Their offer is this. Hey guys, the strait is actually open. You can pay for your oil in Chinese yuan, and then we'll let your ships through safely. Now, Russia has the alternative supply. Every Asian country that's running out of Middle Eastern oil has one alternative seller that is willing to do business right now, which is Russia. And Russia is offering that energy in yuan or rubles. Japan just called Russian oil extremely important for energy security. South Korea is considering importing Russian oil as well. Even the United States is backing off the sanctions on Russian oil, which tells us how desperate the situation actually is getting. And of course, China has the payment rails. Now, what's interesting is that the yuan is not actually freely traded. Like, you can't just go buy it on an exchange right now like dollars or euros. The only practical way to get yuan is to sell something China wants. And historically, what China's always been willing to accept is gold. So the actual transaction looks something like this. You sell your dollars, you buy your gold, you sell that gold to China in exchange for yuan, you take that yuan to Iran, and then you buy the oil and your ship gets home safely. Right, so China now gets to sort of be right in the middle of this transaction. It gets to decide the exchange rate between gold and oil, which means China's deciding what the dollar is worth relative to everything else. Okay, what is the evidence of this then? We can look at something like Swiss gold exports to Saudi Arabia. Starting in 2022, which was when the US froze Russia's dollar reserves, Saudi Arabia started buying gold at a much faster rate through Switzerland. Here's a chart you can see. Now look at Chinese exports to Saudi Arabia over the same time period. Right? Saudi Arabia is buying Chinese goods and gold while selling oil. This next chart shows Swiss gold exports broken down by destination. Look at the Gulf countries category. That's the whole GCC region. It goes up starting in 2022, again, the same year. Every single Gulf country watched the US freeze Russia's dollar reserves and thought, well, hey, if they can do this to Russia, they can do it to us, right? And Switzerland is how they're moving it, using something like an offshore yuan clearing bank account, meaning you can swap gold for yuan there without ever touching the US financial system. And it's not just the GCC. For 3 of the last 4 months, the biggest thing the United States was shipping out of the country by dollar value was gold. Specifically what's called non-monetary gold. That means physical gold, actual bullion, coins, and things like that. The Wall Street Journal reported on this as well, which means the US is already settling a portion of its own trade deficit in gold. And Iran has created a toll booth for the whole world. And the toll booth has to be paid in yuan, which is paid in gold. Now, there is a problem though. The oil market makes about $4.1 trillion worth of oil every year. It's a lot. And the entire gold market makes only about 485 billion, which means the oil market is roughly 9 times bigger than gold. So even if a fraction of global oil starts getting settled through gold as the conversion layer, the demand shock to gold could be unlike anything the market's ever seen, because the gold market is just too small to absorb oil without the price moving in a very big way. That's speculative, but that's one theory. And that's why some people believe that gold could ultimately go much, much higher in the long term. So that is the game. Okay, so while all of this is happening, we're also experiencing pain in the bond market and the stock market. But let me try to make sense of the bond market first. Why is the bond market so important? It's important because the bond market decides what our borrowing costs are going to be in the future. So at the start of 2026, there was basically one thing that almost every major bank and hedge fund agreed on. Interest rates were going to come down, right? The Federal Reserve was going to cut rates. Borrowing was going to get cheaper. And the economy was going to get a soft landing and stocks were going to keep going up. That was the narrative. JP Morgan said it, Goldman said it, everyone was. But what ended up happening was the opposite. Long-term bond rates have started going up. And in just a few weeks, since the Iran war started, the 10-year U.S. Treasury yield has gone up significantly. By the way, I bring up the 10-year Treasury bond because that bond is arguably the most important one to look at when trying to understand what's happening to interest rates. So basically right now, interest rates on long-term bonds are going up, and that is bad. Why is it bad?